welcome to Nirmal, ladies and gentlemen. I'm Hira Dadia. We have with us Mr. Geoffrey Dennis, independent emerging markets commentator, joining in. Welcome to the show, Jeff, and always a pleasure to speak to you and get insights from you. Jeff, overall, if you see in terms of the US inflation data, let's start off with that because that's something which is catching everyone's eyes. For the month of August 2022, what do you make of that number?
Well, the key part, which was very disappointing, I think the inflation report generally is shockingly bad, much worse than people had expected. But the key thing, though, in the report we have to focus on is the core rate, which jumped from a zero point 0.3 gain last month to a zero point 0.6 gain. And that was certainly way above expectations, which means the year-on-year rate is moved back up to 6.3%. I think the headline rate was less disappointing, although it did come in a little higher than expected, plus 0.1 versus minus 0.1. But I think the bottom line here is that we have to focus now, as these headline numbers have come down for 2 months in a row. We had a flat number last month and now plus 0.1 this month. We have to get people to focus on the progress of the core in inflation numbers, the core monthly changes. And if the Fed is looking for a series of low core inflation numbers before they can start taking their foot off the brake, if you like, on the economy, this report didn't help. And in some sense, as I just posted on LinkedIn this morning, it resets that clock back to zero. We're still waiting for a run of good core inflation numbers. And frankly, this was a big disappointment this morning.
Absolutely. So, with the numbers that have come in, do you think it actually opens the door for the Federal Reserve to raise interest rates significantly when its policymakers will convene next week?
Yes, I do. I mean, I felt I was wavering a little bit between 50 and 75 basis points prior to this release. Now I think you can guarantee it's going to be 75 basis points. But I think more importantly, I think it opens the way to further significant rate hikes as we go through the rest of the year and into 2023. So I think you've got to pencil in 75 basis point next week. Let's say 50 and 50 over the rest of the year, taking you to 4 to 4.25% by year end. And then maybe you can start to talk about when we might be at a peak. And so I think what this does is it increases the terminal rate that the Fed funds rate will get to in this cycle. I think you'll start to get people talking about a possibility of close to 5% interest rates at the peak, although I think that's a little bit extreme. But also it means, which I think is quite good, is that it means that we're going to get to that neutral rate, whatever that neutral rate is, and to real interest rates of somewhere close to zero much more quickly now. And I think that's the good side. So the acceleration, start again. The rise in rates will continue to be pretty aggressive, 75 basis points next week. And I think we're going to find big increases over the rest of the year, if not necessarily 75 basis points. There is absolutely no reason for the Fed to take their foot off the brake yet, given this report this morning.
So do you think in the near term, if you look at the 10-year Treasury yields, there is a possibility that we could rise above the 3.6% mark in the coming months?
I've been pushing the line that the 3.48, 3.5% level that we got to in mid-June was going to be the peak, because I felt very strongly that the inflation would get better, the inflation data would get better more quickly than it seems as if it is getting better. And therefore, what the bond market would do would be keying off the real economy rather than the inflation rate. Now, I think you have to reassess that a little bit as a result of this report. So I think that bond yields will probably stay high for a while. I think they may well take out that 3.5% peak that we got to in June. So we may see a move slightly above that. But I still would not get that bearish on the bond market, even if yields do go a little higher than anticipated, because ultimately this aggressive monetary policy from the Fed will start to slow inflation. Just maybe it's taken a bit longer than we anticipated. And once that happens, the bond market is going to rally very, very strongly, because by then the worry will be about the real economy. So I think we're going to see high yields again, a little bit further increases in the short term, and definitely a test of that 3.6% rate. But I doubt even if we do it, we're going to go much higher.
Right. And overall, what's the kind of impact you're expecting in terms of where the stock markets are concerned?
I'm still a buyer for the long term. I firmly believe that despite the disappointment of this inflation report, that the trough of the markets was in mid-June, and I still believe that to be the case. I just think that and I've argued for some time that the volatility would continue, but with a little bit of an upward trend. And I think that's still the case. I think there will be a lot of volatility. But I think that on any significant weakness, such as after today, where the market looks like it's going to fall sharply, I would be more of a buyer than a seller. Because I do think ultimately, if there is a recession in the US economy, it's going to be mild. I think the earnings hit will probably be relatively mild as well. And ultimately, as I say, the Fed will stop tightening and the inflation numbers will start to get better. It's just, I think we've pushed that out a little bit into the future. So I think choppy with maybe a little bit of a downward bias short term, but looking for long-term buying opportunities over the next couple of months or so, because I think ultimately 2023 will be a much better year for the inflation story, for the interest rate story, which will peak, and that will bring people back into the stock market.
Right. So overall, if you see in terms of emerging markets, where are you seeing, traction now? Because clearly the FIs who were sellers, especially for the Indian markets, have now turned buyers in the last 1 month. Are you expecting this trend to continue? And do you think India is an attractive place to be in?
Absolutely. I think it is a very attractive place to be in this environment. If I could just go backwards a minute and look at where we are today in terms of emerging markets. First of all, we're down about 20% in dollars. Developed markets are down about 18% in dollars. So that is a relatively good performance by emerging markets in a year of very, very poor performance by the developed markets. Normally, if developed markets are down that much, we would be doing even worse than we are anyway. That's point number one. If you look within the emerging markets, it's very clear what's happening. China is still a drag. Emerging Europe is getting hit very badly. Obvious reasons for that: hits to the economy, high inflation, the effect of the war in Ukraine, etc. Turkey has been a very poor market all year. Korea's not done very well. And on the good side, you're seeing a strong performance by India. The Sensex is up about 4% this year, as far as I can see. You're also seeing very strong performances by Middle Eastern markets, which are tied to the dollar in a sustainable way and getting some benefit from higher oil prices, taking the year as a whole. And of course, Latin America continues to do well. Latin America is up 3% in dollar terms this year, driven by Brazil. So it's a very interesting backdrop. Now, if I was designing a portfolio today, India would definitely be an overweight. I would be starting to look at China, because at the end of the day, I think that the Chinese authorities have no choice but to provide a very large support package for the property sector, which is unraveling now in China. That's going to be the key turning point in China if we ever do get that. Clearly, the zero COVID policy is a wild card, and we don't know how that's going to play out. I like the look of ASEAN markets, Southeast Asia, which have not done that well this year. I wouldn't go anywhere near emerging Europe. I would remain bullish about the Middle East, because I think the dollar is going to stay quite strong, even if not really going much higher. And I think parts of Latin America look quite good. But within that, because of the growth in India, because it is always a little bit of a safe haven in down markets and a safe haven even within Europe, I think India looks good. Now, people worry about the currency in India. Now, I've just done the numbers this morning. The Indian currency is down about 7% this year against the dollar. That is not bad compared to, for example, the euro, the yen, sterling, which are all down 15 to 20%. It's down less than the Chinese currency is down. down less than the Korean won, which is down 17%. So the currency is not bad. And we've started to see now the central bank moving in terms of the RBI, moving in terms of interest rates. So I would fully expect to see the foreign investor money continuing. So, now that it's begun to return, to continue to return. And I would be overweight India in a emerging market portfolio right now.
Right. And overall, if you see in terms of the European markets as well, what's the view that you pick up?
The European markets, I think, are under severe pressure because of, above all, because of the fallout from the war in Ukraine, in particular, the direct hit to growth that you're going to get from being close to an area that is in conflict, but also, of course, because of the energy crisis in Europe and the shut off of the gas and the reduction in oil imports as well. Now, as your listeners will know, everywhere in Europe is facing very, very high gas bills and oil bills. And that's pushing inflation up, making it very hard for the central banks to provide any support for these economies. So although Europe has done poorly already this year, particularly the emerging European part of that continent, in other words, Czech Republic, Poland, Hungary, the parts that I would care about the most, I think Europe as a whole, because of this growth pressure, because the ECB's got a lot more work to do, and even the Fed, I think now, I would be very, very cautious, very, very cautious about Europe at this point in time. There's one other point as well. Normally, one looks at a strong dollar and says it's bad for emerging markets because it forces interest rates higher, pulls money back into the US. Now, it hasn't been so bad for EM this year because so many countries raised interest rates last year in anticipation of this inflation spike and the dollar move, Brazil being the poster child of that policy. Normally, the stronger dollar is good for Europe because it means a weaker euro and all those great export stocks in Europe, do relatively well. Well, right now, Europe is in no position really for its export stocks to really do well against this background. Global growth is slowing, and they've got their own inflation, interest rate, and cost pressures. So I'm if I was running a global portfolio, I would be underweight Europe as well as being underweight emerging Europe within an emerging market portfolio.
Right. So overall, yes, India does look attractive from what you're saying as well. Thank you, Jeff, so much for joining us on the show. Always a pleasure to get your views and recommendations. Thank you. Stay safe and speak to you soon again.
Thanks very much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.